You're welcome to this channel. I want to speak today on CISA, Certified Information System Auditor, one of the most important certifications in the world in the field of information system auditing, information system consulting, governance risk and compliance, name it. This is one of the most certifications you could, most important certifications you could ever have. All right, so I'll be sharing in this channel my knowledge and my experience as an IT auditor, and in the classroom also. I've been teaching CISA since 2008, and so I've had quite a lot of experience teaching a classroom and mobile platforms also. Okay, so we're starting with domain one, information systems auditing process, part one. Okay, so this particular domain is meant to introduce us into the field of auditing and basically to teach us basic concepts, basic auditing concepts, which we need to be familiar with as IS auditors. Okay, now audit is audits. Incidentally, we have different type of audits. You know, we have environmental audit, financial audit, IS audit, compliance audit, administrative audit. You know, name it. There are various types of audits outside there. Okay, but basically, you see, there are some concepts that are basic for auditing generally. And those concepts are what domain one is actually introducing to us, all right, as IS auditors. So we want to be grounded. So many of you watching this video, many of you are from various backgrounds, or maybe from IT. You know IT already. But what about the auditing aspect? So this domain will teach you how to put on the auditing cap, regardless of your background. Okay, so let's give it a go. Let's start from audit planning, all right? So every auditor, every audit must be planned, all right? So we have audit planning, then we have audit execution, then we have audit reporting. Those are the three phases we have in audits: audit planning, audit execution, and audit reporting. Now, if you drop the ball in any of those three phases, then there's going to be a problem, okay? So audit planning, I say in the audit classes that audit planning is actually information gathering, right? The best auditor is the most informed auditor. So the success or failure of audit planning depends on the level of knowledge you've been able to acquire about the audit area. And of course, the audit planning will also, will be extrapolated into the audit execution, and the audit execution will be extrapolated into the audit reporting. So this is the foundation. So what is IS audit? IS audit is the formal examination and the testing of information system to determine whether information systems are in compliance with applicable laws, regulations, contracts, or industry guidelines. So the auditee is PCI DSS certified. The auditee is ISO 22301 certified. The auditee is ISO 9001 certified. The auditee is GDPR certified. All right, it should be your concern as an IS auditor, right? You need to check what is going on in the organization, compare with what those laws, those standards, those regulations, contractual requirements say about what should be going on in the organization. All right, so a good IS auditor is very knowledgeable on industry regulations. So, you know, when you see IS auditors having certifications upon certifications, it's not for show, it's to demonstrate capacity, to demonstrate knowledge, especially when you are doing compliance audits. So you have to have knowledge. Number two, to determine whether information systems and related processes comply with governance criteria and related and relevant policies and procedures. So the internal policies of the organization itself, are they complying with it? Right? So we check the information security policy, we check the risk management policy, we check the IT procurement policy. What is being done? Is it in line with what those policy statements have said? Number 3, to determine whether IS data and information have appropriate levels of what we call CIA, confidentiality, integrity, availability. What's confidentiality? If you are not authorized to see an information, you shouldn't see it. All right, so do we have the right level of access controls? Do we have the right level of rights management? Do we have the right level of encryption? All right, so physical, logical controls to enforce. That needs to know. That's confidentiality. You want to prevent unauthorized disclosures. Integrity, the hard. Right? Data should not be alterable without authorization. Data should not be modifiable by internal or external parties without authorization. So we should have reliable data. We should have data we can trust. That's integrity. Availability means our platforms, our services should always be up to meet the needs of the stakeholders. Downtime, as we will soon learn in domain 4, recovery time objective should, all right, downtime should be minimized to the RTO threshold, to the recovery time objective threshold. The number 4, IS operations are being accomplished efficiently, optimal use of resources, effectively, we are meeting IS targets. And if you are meeting IS targets, it means we are meeting business targets. We'll talk about that in domain 2. This is what IS audits is all about. And when you are planning for an IS audit, you must incorporate risk assessment into the planning. This is very important. You must incorporate risk assessment into audit planning. And like I said before, risk assessment is basically knowledge dependent. For you to do risk assessment, all right, for example, in ISO 31000, we're told risk assessment is risk identification, risk analysis, and risk evaluation. And that still takes knowledge. It's still a function of information available to you. As an individual, as an IS auditor, as an audit team. So that's why one of the first things you do when you get an audit engagement, all right, either as internal auditor or external auditors or external consultants, all right, you actually have to research, you have to ask questions, you have to gather information about that audit area, so that you can be able to understand the areas of high risk. So you don't major on minor, you want to major on major issues. What are the issues that can affect the organization strategically? What are the issues that can affect the organization operationally? So when you are planning for the audit, focus on the areas of high risk in that audit. And like I said, it's all about information. So how do you gather this information? You can talk key organization first. You can move around. Look at the data centers they have. Look at their offices, look at the branch network, look at their warehouse. Just go around, you get information. Right, read background materials about that industry publications, annual reports. Review business and IT long-term strategy plans. Interview key guys in that organization. You will get information. All right, locate and document laws and regulations applicable to IT in that environment. Then identify IT functions that are being outsourced. Right? Like we'll talk about that in domain 2 outsourcing. You can outsource responsibility, you can't outsource accountability. Accountability stays with you within the organization. So when you are performing an IS audit, you also need to be concerned about IT functions that are being outsourced. So to perform audit planning, gain an understanding of the business mission, objectives, purpose, and processes. Understand why they are existing. What is the business mission? What is their strategy? Who are their customers? Who are their regulators? Who are their competitors? What are their products? What are their services? You don't know. Identify the controls they have within the organizations. Review their policies. All right. Review their standards. Review their guidelines. Review their procedures. Review the organogram, the organizational structure. You will be surprised what you will see. Sometimes the problem in an organization is the reporting line. All right, so you have head of IT, all right, or head of data center reporting to somebody that does not have IT technological appreciation. There's going to be a problem. We're not saying the CIO must always come from technical background. Of course, that is changing. But still, whoever is going to be the CIO, all right, must be somebody that has, technical appetite, technology centric. Even if the person is coming from a business background. You have a CISO reporting to CIO. There's going to be a problem. Or you have a CIO reporting to CFO. Organizational structure, that's problematic. Perform risk analysis, all right, to help in designing the audit plan. Okay, we'll talk more about risk analysis in domain 2. I talk about ISO 31000, all right, risk assessment, identify the risk analysis, try to determine the likelihood of the risk, the impact of the risk, the frequency of the risk, and you can do that qualitatively, you can do that quantitatively, you can do that semi-quantitatively. All right, so you perform the risk analysis, all right, to be able to rank the risk. Is the risk high, is the risk low, is the risk medium? Then, of course, internal controls are responses to risk assessments. All right. So when you perform a risk assessment, the output of the risk assessment is a feed, it's a feeder. All right, is an input for the design of control in an organization. So once you're through with your risk analysis, you already know where the danger points are in that organization or in IT. Then you can review the internal controls you have in place so that you can compare the controls with the risk. They determine the adequacy. All right, so setting the audit scope and audit objectives, develop the audit approach or audit strategy, assign personnel resources to the audit based on their skills, based on their competence, based on their experience. Then address engagement logistics. You don't want the auditors to be stranded. So they're going to eat, all right, accommodation, transportation issues, all right, equipment needed, software needed, and so on. So you have to also address those logistics also. Now, ISACA IS audits and assurance standards. Auditing is very, very critical. And you see, sometimes audits can be a matter of life and death. That is the truth. Why am I saying that? Let me explain what I mean. So you have this PLC. I don't want to mention name. There are case studies. If you go online, you see case studies of businesses that collapse, public companies that collapse, and you see people, the shareholders, committing suicides because all their interests are in that, maybe their life savings, some of the workers, their life pensions, everything are within the organization. All right, and maybe some of them are nearing retiring years, and everything just go down like that. So they are left with nothing. No, and some of people just give up and just die. So the question, when corporations like that fail, where are the auditors? Where were the internal auditors? Where were the external auditors? So this is a challenge. So because of the implications of audits, audit failure, which is called audit risk, the auditing field is one of the most regulated fields in the whole world. Everybody wants to regulate the auditors because audit reports have serious implications. It has investment implications. All right? It has even sustainability implications. It has reputational implications for the auditors and for the auditee. And so the auditing field is highly regulated. And one of the regulations that we have here is auditing standards. Auditing standards are mandatory requirements which you expect an IS auditor to comply with. Luckily for us, CISA has developed what they call IT assurance framework, which is to give the auditors, the IT auditors, mandatory requirements which are not negotiable. You have to follow them. Okay, this IT assurance, information technology assurance framework is divided into three. You have the general standards, you have the performance standards, you have the reporting standards. Those are the three standards that we have. Now, the general standards are 8, starting from what we call the Audit Charter 1001. So what is Audit Charter? Audit Charter is a document, all right, that is used to assign authority, responsibility to the internal audit function. Now, traditionally, audit, risk, internal control actually primarily is the job of the board of directors. All right, but how many times does the board meet in a year? All right, maybe relatively, once a quarter. That's like 4 times. Of course, the committees here and there might be meeting, but the entire board. So it is very difficult for the board to be the one carrying out internal audit function. So there have to be an internal audit function within an organization that is empowered, that is authorized to do that on behalf of management. And that's why you have the internal auditors. And that those internal auditors must be empowered. People must have that understanding that these guys, all right, are standing for management in this organ. They are the management eye in the organization. So we create a document stating the authorities, stating the roles, stating the responsibilities of the internal audit function. So this empowers the internal auditors in the organization to function. If it is the external auditors we are considering, then we'll be looking at engagement letter, right? Engagement letter, right, is for the external auditors, right? But for internal auditors, the umbrella documents that actually empowers them to function is the Audit Charter. 1002 is organizational independence. What does that mean? Avoid self-review. You cannot audit yourself. So if you are being involved in a process and management is telling you you are going to be the audit of that process, educate management. And also, as an internal auditor, for example, you cannot just say a blanket no. That's why you are being paid, but you must educate them. All right, that's what CISA says. Right, you have to educate them that there is an implication, right, because you are now reviewing your own work, and that will affect your independence. That is professional independence. All right, so I've been part of a software development team as I'm an internal auditor, but I've got Java skills. All right, so they called me as a guy, help us now. You have Java experience, you're having some difficulties, can you help us with this? And of course, your department, since the same organization you are working for, they release you and you are part of the coding team. Now, when it's time for post-implementation review, we talk about that in domain 3. So when it's time for post-implementation review of that project, they are now adding you again the post-implementation review. There's going to be a conflict. Professional independence. 1003 is professional independence, and that has to do with the perception of an outsider when he or she is looking at the relationship between the auditee and the auditor. So it's about the relationship, avoiding bias, avoiding situations, events that can, kind of cast it out about the integrity of the auditor. Familiarity, over familiarity with the auditee, all right, will impair your professional independence. All right, taking material gifts from the auditee will impair your professional independence. What else again? Intimidation. from the clients. If it's becoming too material, you may need to walk away to preserve your professional independence. So in your relationship with the auditee, be very careful of events that may or may seem to, all right, cloud your judgment as an auditor. That is what professional independence is all about. The 1004, reasonable expectation. Now, there's no perfect audit. There's no absolute, there's no absolute assurance in audits. There's no audit that can tell you, oh, there's no fraud, absolutely, in this organization, or there's no irregularity, right? Because you don't do 100% testing. Most audits is based on sampling. We'll talk about that in part 2. Okay, so, but you should still plan the audit in such a way that we should have a reasonable expectation that we can rely on your work. So when an auditor is submitting an audit report, we should have belief. We should have that trust in that report based on the level of knowledge, the level of experience, the level of compliance, the level of carefulness you have put into the job. So an audit report should be able to have what we call reasonable expectation in terms of the work that the auditor has exerted on that audit. So every audit report should be able to have, we should be able to have reasonable expectation that the audit is well done. 1005, due professional care, still tied to 1004. Every auditor is expected to exhibit due professional care in the course of doing his or her work. We cannot afford to be negligent. There's what we call professional skepticism in audits. So if you have cause to doubt, then you should doubt. Doubt is allowed in audits. If you are not sure, if you suspect, follow up the suspicion. You have an intuition, follow up the intuition. That's what 1005 is all about, due professional care. 1006 is proficiency. Every auditor is expected to be proficient, have appropriate skills, especially IS audits. IS audit is a technical field. So you cannot just say, okay, especially for people that are coming from other areas, business areas. All right, this sometimes can be very, very, argumentative. But that's the truth. For many of us coming from business areas, don't be afraid, right? You are in the right place, but man, you got to skill up. You have to skill up. I came from accounting background, right? But along the line when I wrote CISA, I realized, man, I have to add to myself. So I have to go for CCNA training, networking training. I have to go for OCA, Oracle, database management training. I have to go for certified hacker training. All right, and I keep learning. Keep learning. So you keep on building on that proficiency to add value. Assertions 1007. Assertions are made by management. It is the job of the auditor to confirm, to validate or invalidate the assertions. So anybody can present a report to you while in the course of audits. It is an assertion. For example, let me use financial accounting, for example. So you look at the financial statement of an auditee, you see non-current assets, $20 million, non-current assets. Now, that non-current asset, there are a lot of assertions there. Number one, there is an assertion of occurrence. All right, that is, we are assuming, we are certain, management are certain that those non-current assets, all right, maybe like machineries, equipment, cars, that they are existing. They might not be existing until you confirm as an auditor. That's an assertion. Assertion of occurrence. There is assertion of valuation, all right, because in many audits, All right. The management can assert any evaluation. But by the time you start auditing and checking, what they call fair value in IFRS, you might discover that the fair value might not be what might be far lower than what is on the financial statements. So valuation assertion, existence assertion, occurrence assertions. What about ownership assertions? The non-current asset may be there, it may not be their own. We've had cases whereby, during end of year, you see companies will go and, maybe go to the peer organizations or friendly organizations and borrow for the window of the audits, borrow assets and move it to their premises. It's not their own. So you will cite it till you think it's theirs until you start checking for titles. All right. So, we want to see documents that verify ownership. So these are assertions. I just wanted to be able to know what we mean by assertions in audits. So anybody can assert anything. If the auditor must have, techniques and standards and framework to confirm, validate or invalidate the assertions. And that will lead us to 1008 criteria. So criteria are the best practices that the auditors use to either confirm or invalidate an assertion. For example, ISO 27001. If I want to audit information security management system in an organization, what criteria will I use? I will use 27001. That is standard on ISMS. I want to audit business continuity and disaster recovery in an organization. What audit criteria will I use? I will use ISO 22301. If I want to audit financial statements in an organization, all right, at least in Nigeria and some other countries that have adopted IFRS, I will use IFRS, National Financial Reporting Standard. That's what we mean by criteria. Sometimes the criteria, audit criteria may be internal, might be the internal policy of the organization. All right, the internal policies might say, yes, for example, password policy. So password should be minimum of so characters in length. And I will use that as a basis to check maybe the group password policy. All right, to check what is implemented on Active Directory or on the application server. Okay, so that is using an criteria can be internal, can be external. So the auditor, depending on the kind of audit that the auditor is carrying out. So these are the general auditing standards, 8 of them, right? Then we have 7 performance standards, 1201 engagement planning. I've talked a little bit about it. So you don't rush into an audit because the audit planning is a foundation. So you've got to get knowledge about the audit scope, audit objective, all right, what needs to be done, what information needs to be gathered, what tools you are going to use, what people will you need in terms of competence and experience, what kind of reports are you going to write, to whom are you going to write the report, when are you going to write the report, what medium will the reports be written in, all right, what is the project calendar for the audit execution. You do all that in engagement planning. Then 1202, risk assessment in planning. I've talked about that. So when you are planning the audit, focus through knowledge information gathering on the areas of highest risk. Areas of highest risk in the audits is what will determine your focus so that you don't waste time and you don't create what we call audit risk. I will talk about audit risk as we continue. 1203, performance and supervision. Right? You don't leave auditors on their own on the field. That's why I like the external auditors, the big 4. They have a structure. Big 4, big 5. They have a structure. So you are going, many of them are going to have, the general pool of auditors. You are going to have seniors, all the seniors. You are going to have the deputy managers. You're going to have the managers. All right, you're going to have the engagement partner. Then you're going to have the managing partner in some organizations. Some of the other firms, you have a quality control manager. Again, wonderful. To ensure quality. That's why I put ISQC1 here. You may want to download it, all right? International Standard on Quality Control 1. Man, I love that standard. Even though it's a standard for audit firms, but man, every auditors needs, every audit department, either external or internal, need to go through that document. Yardstick for running an audit department. You will see it in ISQC1. Performance, reviews of reports, supervision of subordinates. These are things you cannot negotiate in an audit. 1204, materiality. You cannot audit everything. So you have to focus on what matters. And what matters is relative to the organization. So what matters in a commercial bank, all right? What matters to a what is it called, a microfinance bank may not matter to a national bank. So we look at materiality from size perspective, but we also need to look at the nature of the transaction, because some transactions are not so big, but when you look at the implications, the nature, they can raise flags. A good example is an organization where they are doing contract splitting. So if you want to follow materiality strictly, the auditor will miss, all right, the practice of contract splitting in that organization. So, for example, now in auditing standards, international auditing standard IAS, okay, developed by International Auditing Standards Board, IASB. Okay, they differentiate between two materiality thresholds. So you have the normal materiality, you have what they call performance materiality. So the materiality might be maybe $500,000. Then the performance materiality may be lower than that, $100,000. The idea is that you don't keep your eyes just solely on the high materiality threshold, because there may be some transactions that may not meet your materiality threshold, but they might be indicative of irregularity. So you still have to keep your eyes open while you are still focusing on materiality. All right. Then, of course, 1205, evidence. Every audit report must be based on verifiable information, verifiable evidence that have been gathered through the efforts of the auditor. We'll look as we continue on how or means by which auditors gather evidence. 1206, using the work of other experts. And so in audits, sometimes you might not have competence in certain area. So you may have to hire experts. So there is a standard on this. But note number one, you are accountable for the experts you hire. So you cannot say, oh, wow, but this audit, our conclusion was wrong because of the expert we hire. So the fault is on the expert. No. So the fault is on you. So you have to look at the competence of the expert. You have to look at the educational qualification. Where has the expert, which conference has the expert spoken before? Which books have the expert written concerning that area? All right, look at the integrity of the expert, then look at the independence of the expert also. So all these considerations must be looked into by the auditor before you hire an expert, because the opinion of the expert ultimately becomes your opinion the moment you include it in your audit report. 1207, regularity and illegal acts. So every audit must be planned to uncover fraud and irregularity. Earlier I talked about professional skepticism. So when you are in an organization and you're auditing, all right, you must keep your eyes open for signs, signal, like that's what I call it, fraud signal. Right? Every fraud has a signal, which unless you are trained or you are alert to, you are looking for it, you might not see it. So every audit must be planned with that intention to uncover irregularity and illegal act if it is present within the organization. Of course, for external auditors, it has always been argued that it is not their primary duty to uncover fraud. All right. But even then, international auditing standards have always made it clear. For external auditors, it might not be your primary duty to uncover fraud, but you must plan your audits, all right, in such a way that if there are irregularities, you should be able to uncover them. Okay, so those are the 7 performance standards. Then, of course, we have 2 reporting standards, 1401 or reporting. So, based on the evidence the auditors have gathered, to write an audit report. All right, we'll talk more about the audit reporting in subsequent videos. There are 1402 follow-up activities. At the end of the audit report, you have raised exceptions or non-conformities. You have made recommendations. Those recommendations may not be followed. All right, a lot of times auditors write audit reports, all right, submit it. The next year, when they come for the second, maybe the surveillance audit, the issues that they raised the previous audit are the issues they will raise again in the second year audit. Why? There was no follow-up. So you need to follow up to ensure that the recommendations you made have been implemented by the auditee. That is 1402. So those are the auditing standards, all right, the general standards, the performance standards, and the reporting standards according to the IT assurance framework. Okay, so let's look at this review question. IS audit professionals should demonstrate organizational independence by A, not collecting material gains from the auditing management, B, being conscious of possibilities for fraud and irregularities in the course of the audit, C, getting the required skills and competence for audit engagement, D, not permitting self-review. So if you look at A, B, C, D, what do you think should be the answer? All right. For me, remember, with the keyword here is organizational independence. Remember, I said it that in the auditing standard, organizational independence means you should not review your own work. All right. So definitely the answer is D. All right. Do not review yourself. Do not review your own work. So the answer here is D. Now let's talk about business processes. I talked earlier that audits planning is about information. Information about what? One of the key information you must gather in audit planning is information about the business process. So you have to know the data flow in the organization. So you have to study data flow diagrams. You have to study process design diagrams. All right. You have to study the applications running, the enterprise architecture in that organization. All right. So you need to understand the system. You need to understand the business process. A lot of questions in domain 1 will focus on whether you understand that. You cannot audit a process without understanding it. So the more, even application audits, you don't just jump and start auditing an application without first studying the process, the business process, all right, that application is powering. Every application is powering a process. That's what you call automation. There has been a process before computerization. All right, computerization is just automating it. So what is that process that we automated? You have to understand it before you can start auditing. All right, review question 2. Which of the following is the best factor for determining the required extent of data collection during the planning phase of an IS compliance audit? A, complexity of the directions operation. B, findings and issues noted from the prior year. C, purpose, objective, and scope of the audit. D, auditor's familiarity with the organization. What will determine the kind of information, the kind of data you are going to gather? For example, are we going to gather data of just 2022, or we're going to gather data of 5 years, or we're going to gather data of 10 years? What do you think will determine the kind of the departmental data? Are we going to gather data only from IT, or we're going to gather data from other departments? These are issues. Or we're even going to gather data from outside the organization. Definitely the best answer here is C. The purpose the objective, the scope of the audits is going to determine the extent of data and the kind of data we are going to gather. So the best answer here is definitely C. Okay, look at this question also. An IS auditor is developing audit plan for an environment that includes new systems. The organization's management wants the IS auditor to focus on recently implemented systems. How should the IS auditor respond in this situation? So it's an existing organization. They just got new systems and they said, guys, auditors, forget about the old system. You know, you audited them last year. We just got new systems. Just focus on these new systems. So how should the IS auditor respond in this situation? Audit A, audit the new system as requested by management. B, audit systems not included in last year's scope. C, determine the ISO systems and plan accordingly. D, audit both the systems not in last year's scope and the new systems. Remember, we talked about the risk assessment in audits. All right. So what matters is not whether they are old or they are new system. What matters is what are the IS risk systems. Whether they are old or whether they are newly acquired does not matter. So we need to determine the IS risk systems and plan accordingly. The best answer here is C. So ladies and gentlemen, I will be adding the part 1 of this video here. I'll be dropping other videos on domain 1, and from there we'll just proceed to domain 2 up to domain 5. So I want you to be part of these videos. So definitely I will want you to subscribe to this channel if you have not subscribed, so that you'll be able to get alerts when I am dropping subsequent videos. Thank you.